That leaves us chapter 13. Chapter 13 is not heavily tested. I want you just to be aware of a few things. Once again, don't memorize anything. There will be a couple of slight questions in the end of the Blackboard quiz, and you can use those notes and the PowerPoints that are here to look up anything that relates to this chapter. We won't go deep. We'll try to keep it as simple as possible. There are three choices for an accounting period. The first one is the calendar year. The second is a fiscal year, which would be ending at the end of any month. And the third is a 52, 53-week year. And what that means is payroll closes every 2 weeks. So sometimes the last payroll ends in the last week or so in December. Sometimes it runs over to the first week in January. So we're always closing our year end on the date that payroll closes. If you want to change your accounting method, you must request permission. The math that's related here is pretty complicated. You can't just change willy-nilly. You have to have a reason, and you have to file a short year return. That means if you decide in June that you want to move to a year end other than December, then you would have to close out from January through June and then elect a 12-month period that would be applicable. And in very complicated math, you have to annualize, something similar that you do when you're doing the 10Qs, the quarterly statements for GAAP, so not much different than that. And then some entities have required years to end a calendar year. If you are the three kinds of things listed here, you are generally required to have a December 31 year end. Partnership year end depends on the partners. If you have 3 partners who each own 20% and their year end is October 31, the year end will be October 31 because that's what the majority of your partners' year's end is. And then there are other exceptions. A natural business year, 25% of your receipts in the last 2 months. So a toy manufacturer might be a good example of this because in October and November, or perhaps November and December, is where a significant amount of toys get purchased. So the company might decide that it wants a year end that closes on November 30th instead of December 31. Pretty complicated area. We're not going to go into it in any depth. I just wanted you to understand that just not anybody could choose to have a substantial business purpose drive their year end. And then this 444 election, a few years ago, it was determined that perhaps a non-calendar year made sense. But what they do is they make you pay taxes or interest, if you will, on the 3 months. So if you elected a September 30 year end and you were supposed to have a calendar year, you have to pay an interest charge for those 3 months that are not being included in income. Once again, a whole lot deeper than we need to go. The 3 bullets here demonstrate some more of the complications that are involved. The IRS has the right to come in and change your year-end or accounting methods if they do not feel that you have clearly reflected your income. And you must be able to reconcile from book to tax. If that doesn't happen, they can force you onto the book method of accounting with whatever adjustments are different for tax. And then if you have more than one business, you need to keep separate records for each business if you're going to treat them differently. We're going to see later that some entities have to have inventory, others do not. And so you would have to separate out your manufacturing that requires inventory from your dental supply services, which may not require inventory, or you have to use inventory for everything. So when you commingle, the more complicated set of rules would control. Not everybody can use the cash method. These are just 3 items. Large corporation is defined at length in the book. So if I ask you about a corporation, a regular, C, remember, is regular corporation, with relatively large amounts of income, you want to find the example in the book. It's pretty complicated, but with the example in front of you, I am confident that you could find a solution. We've got some slides talking about inventory, and we'll talk about them when we get there. A tax shelter, we'll talk about what that is later in the semester. Essentially, it's an entity that has been formed in order to give you big tax deductions. And there are some rules about $1 of investment giving you $4 of deduction. That's the definition of a tax shelter. And so we'll talk about that when we get there. And then a cash basis taxpayer, we've talked about a lot of this before. Cash is income when received. The cash equivalent, that means if I get property or services or a note, I have to figure out whether or not that is the same as cash. If it is, I must recognize the income. Constructive receipt, we talked about that back in the first part of Chapter 4 and 5 PowerPoints. It could come up again here. Deferred compensation, we talked about if you have any kind of set aside for yourself, any protection from general creditors, it's income when that protection sets up, not necessarily later when you get the cash. And then remember, we have our imputed interest and our OID rules. Those trump cash basis taxpayer rules. Accrual basis, mostly the same as GAAP. When the income is earned and the fixed and determinable, when it's fixed and determinable what that amount is. Remember, prepayments are always income as received, or generally, because there's always exceptions to what we're doing. The claim of right doctrine says if you have the cash, you have the income, even if you have to give it back later. There is no such thing as a contingent liability or unearned revenue when it comes to tax. And then what is here? The general rule for deductions, cash basis taxpayer, you deduct when paid. There are some exceptions. As a general rule, both rent and prepaid interest cannot be deducted in full. For many times, the IRS will make that same rule for prepaid insurance. So anything that extends substantially past year end, and that's generally held to be throughout the next year. Examples in the book. So if in December I would for some reason pay for 15 months rent, I would not be able to deduct all 15 months because we've got 1 month in this tax year, 12 months in the next tax year, and we're lapping over into the third tax year. Once again, the examples in the book. If you get a question, make sure you look it up. And then some more general rules. When you use third-party monies, that equals payment. So you use a credit card to make a payment. That counts even though you may not have to actually pay the credit card company for another month. And then once you put a check in the mail, that is treated as a payment, even if it takes several days for the check to reach the recipient. And then prepayments, the IRS always has the substance over form doctrine. If you own one cow and you buy $10,000 worth of feed, enough to last for the next year and a half, the IRS could come in and disallow that deduction for feed under the argument that you're simply trying to accelerate deductions in order to shelter current income. And then some differences with accrual. The general rule is the GAAP rule, deduct when the liability is fixed. And you can use reasonable estimates for tax. If you know that the liability is fixed as of December 31, but you don't know what that amount is, you can guesstimate. If you are wrong, there are mechanics that would have you adjust in the next tax year so that you don't have to go back and amend the year where you were guessing. Contingencies and reserves are not recognized for tax, so you would not be able to have deductions relating to them. And then remember, we talked about contested liabilities. If you have the cash and they want it back, you recognize the income now and worry about it later if you have to give it back. And we're not going to deal anything with changes in accounting methods other than to know it's really, really messy. You must get permission for most changes. It's always okay to go from cash to accrual because the IRS perceives of the accrual basis as being better. And so if you want to go from cash basis to accrual basis, there are some procedures in play where you don't have to ask for permission first. And anytime you change a method, you are usually going to have to pay taxes up front. because part of the presumption is one of the reasons why you want to change is because you want to reduce your taxes. So there's some complicated math figuring out what you are saving, and then you have to pay the taxes back on it early. And once again, we're just not going to go here. So just remember that to change your accounting method, you have to get permission. It will probably cost you money. Inventory, we have some slides. This is your cost of goods sold. The rules are pretty much the same as GAAP, right? The matching of revenue and expenses, especially for a cash basis taxpayer. So the basic reason for inventories is simply to make sure that you don't buy 10,000 Barbie dolls and deduct them all today, even though it's going to take you 6 years to sell them all. And then we have some slides on when inventory is required, and then how to value it, and that's going to be the same as GAAP. No surprises there. So once again, the reason for inventory, first of all, gross income, and that's a really important term, right? Because gross income is a wealth measure. It is defined for a manufacturer or merchandising as sales minus cost of goods sold. And then we want to make sure that the inventory is not being used to shelter too much income. On the other hand, we want to make sure that we have return of capital here. And so the primary rule here is to make sure that the cash basis method, you don't go out and buy a whole bunch of stuff that's going to take you a long time to sell and land up with a big cost of goods sold, even though you haven't sold it yet. So when are inventories required? Well, and the opinion of the secretary. So the answer is whenever you are told you have to, but there are some pretty straightforward rules that can control most things, right? If they are necessary to reflect income, when you're producing, when you're purchasing, when you're selling merchandise, those would be the times that you would think that I have to have some inventory. And it's an income producing factor. So if you're a dentist, most of the stuff you own does not have to be inventoried, but if you have a stock of gold because you're still doing gold fillings, then you can't buy a whole bunch of gold and deduct it. The gold is part of the process of producing income when you fill teeth. So you would have to have an inventory for your gold. And you could only expense it as you actually charged it out and put it into teeth. So what must be inventoried? Basically, it's raw materials and supplies that you're either going to resell or you're going to assemble into some sort of product that you sell. So if you are a large animal vet, syringes and bandages probably don't need to be inventoried. But if you have some medications that are fairly expensive and you bill separately for them, you would have to inventory them. There's an interesting set of cases about undertakers. Undertakers argued that the coffin was not integral to the production of income for their funerals, and they argued for a long time that they should not have to capitalize them. And the court ultimately determined that if you don't have a coffin, you don't have a funeral. And so all of the undertakers had to start capitalizing the cost of their coffins. So the rules can be just a little bizarre depending upon your line of business. Valuation of inventories, you can see these are pretty much the same as you have in GAAP, and there aren't any real significant differences. Two more slides. Long-term contracts. Once again, like GAAP, they have special rules, and they're not different to speak of. I will not test you on them. The biggest difference between book and tax is that if your percentage has been off, you may have to go back and pay back some taxes because you were wrong in your guesstimate of what the income should have been in the first 2 years if it took you 3 years to complete the project. And now this last bullet, it's pretty normal that when you are short on taxes, you have to pay interest for any monies that you're paying back 2 or 3 years later. But those interest rates are pretty low. We'll talk about them when we talk about estimated taxes. And then last but not least, installment sales. I'm not going to formally test you on those at all. We have a tax return that we will do the tax form for an installment sale. It works once again just like GAAP. All right, so your gross profit's 3%. So 3 cents of every dollar gets reported as income as you collect the cash. In tax, there are some restrictions about who can use the installment method, but once again, way beyond where we need to be. Well, that was longer than normal, but I wanted you to have several examples of filing status and exemptions, since that area is heavily tested on the CPA exam. And of course, the kitty tax is just a little bit of a mind bender. So if you took the time to go through all of those examples, you should be in pretty good shape. Not much tested out of Chapter 13. We'll keep it simple. I may give you a problem out of either deciding whether someone can use the cash basis method, something like that, where you can follow the example in the book during your group quiz. So once again, try to spend some time doing the homework, or at least read the question, read the answer. That's much more efficient than reading the book from cover to cover, because after about 4 minutes of highlighting, you're just zombie-like as you move through, and your ability to retain stuff is really limited. So I'll see you in class. Remember, this is the week where the test and the quiz will be on PowerPoints 4 and 5, Part 2.